Good afternoon, everyone. I know you got like a mouthful of food. There's sandwich all over the table now. I apologize for that. It is so great to be back in Placer County, here in Placer Valley. It was 2 years ago today, not quite today, but about 2 years ago when I had the last opportunity to join you here talking about what's happening in the state of California, what's happening, of course, right here in Placer County, and of course, where it's all heading, and maybe a little bit as to why it's happening that way. Now, to give you a little bit of a refresher, I have a little company called Beacon Economics. We're based out of Los Angeles, California. Try not to hold that against me. I founded the company over 20 years ago with a basic mission. My mission was to provide, well, answers based on data, which to me seemed like such a fundamental thing, but of course it's not something you see very often in the real world. And I would tell you over 20 years, it almost seems like it's getting worse and worse and worse. And with that in mind, let's talk a little bit about what I want to talk about today, today's presentation. Because there's really two big things we're going to be talking about here on stage today. The first thing is what we think is happening in our economy. Might want to call our lived experience, as the case may be, our social narratives, the conversations we hear on a day-to-day basis. I just did one of the breakout sessions. I got to hear a little bit of the narrative from the group of people who came in and joined us for that particular day. The other thing I want to talk about is sort of my specialty, what's actually happening in our economy. What you might want to call our objective statistical reality, the day-to-day numbers that I just kind of examine to get some sense of how things are going, where things are heading. Now, I appreciate that these two things seem like they should be the same, right? Shouldn't our narratives be linked to our day-to-day reality? And, you know, that's what I was trained. Back in the day when I was doing my PhD at UCLA, it was called Chicago West, I was trained in this basic assumption, the idea of the rational economic agent. But again, once you get into the real world, you start to appreciate that it may not be quite that clean. This is one of those assumptions we may have carried just a little bit too far. And what I've realized as a forecaster, if you really want to know what's going to happen in our world, you have to pay attention to both. You have to listen to the narrative, and you have to look at the numbers. Why? Because ultimately, it is narratives that drive choices. The choices of households, the choices of businesses, and of course, the choices of policymakers. Yet, it is economic reality that will determine the outcome of those choices. So you have to really have both of these in order to understand what's going to happen next. And, you know, the basic rule is this. Good policy starts with the right narrative. And if you're starting with the wrong narrative, it's very hard to land on the right policy. So getting the narrative to line up with statistical reality is something that is incredibly important for economic development, no matter where you happen to be in this particular world. Now, with all this being said, there's going to be a lot of slides here. I got a lot of material to get through in just a short period of time. I've already seen people pulling out their phones. Don't. As I wrap up the presentation today, in the last few slides, you will see a QR code. Have your phone ready for those last couple slides, get a picture of that QR code, and you'll be able to get the PDF of this presentation delivered to your inbox in your email. And if you want to find anything else about my company, you can also go ahead and use that particular link. So, with all that being said, let's jump right in. It is interesting that I was here 2 years ago today, because it was 2 years ago today where we started hearing about the recession. You remember this? 2 years ago, we were all told that any minute now, a recession was going to be crashing upon our shores. And we waited on pins and needles through all of 2023, waiting for this recession to happen, and didn't show up. In fact, by the end of the year, what happened? Well, the inflation rate started to drop. You started hearing about the Federal Reserve cutting rates on multiple occasions. The stock market's taking off. And we came into 2024. And, you know, I remember in April, the Wall Street Journal had an article, Envy of the World. That's a pretty nice change in 18 months. We went from being absolutely assured to fall into recession to being envy of the world. And just 2 months later, we saw a couple percentage point BIP increase in our overall unemployment rate, and next thing you know, there's a 40% chance we're already in a recession. Now, if you're looking at this and you're starting to get whiplash, well, yeah, me too. And I listen to what our forecasters are saying out there, and it reminds me of one of the old expressions about economists. An economist is an expert who will know tomorrow why the things he predicted yesterday didn't actually happen today. Now, we did not buy into this. 2 years ago when I was with you, I said the economy is going to continue to grow, and it really has continued to grow. And we put our money where our mouth is. I contributed to that Wall Street Journal survey of forecasters, and you could see us along the bottom. The average at one point in time in 2023 was 60%. The average forecaster said there was a 60% probability of a recession in the next 12 years. The highest we ever got was 20%, and I swear to God, it was just peer pressure. I'm like, wow, everybody's panicking. What am I missing here, right? But since then, of course, our numbers continue to be down. And I'll just give you the quick upshot right here. We aren't worried. We still aren't worried. Why? Because the American consumer is alive and strong. And that, of course, is the dominant thing to be thinking about, right? Consumer spending is nearly 70% of GDP. Ergo, if the consumer's healthy, the rest of the economy is going to come along with them, as the case may be. Other good news, the Federal Reserve has finally started to cut interest rates, and we've seen an increase in overall labor force growth in the United States. One of the critical issues in our nation has been a lack of workers over the last couple of years. It's nice to see our labor force starting to expand a little bit faster. Now, with all that being said, I'm not suggesting that everything's fine. There are absolutely challenges our economy is facing. For example, how about that federal deficit? 6.2% of GDP, one of the largest full employment deficits this nation has ever seen. In fact, the only time it was this big was back in World War II, 120% debt to GDP. And of course, on the other side of that, asset markets, which seem to be ignoring the deficit completely, and you see stock prices rising to all-time high levels. And all of this means that, if anything, the U.S. economy seems to be overheating, and you certainly see that in our external accounts, which are becoming wider on a month-to-month basis. Now, this, of course, gets me to the real heart of the conversation today. What is my real worry? It's not so much that we think it's bad when, in fact, it's good, even though really it's good because things aren't that bad, or are actually getting bad. I didn't say that quite right, but you know what I meant, right? But the real question here, the real issue for me, is the fact that the stories we're telling about our economy are largely out of line with what's actually happening in our economy. And go back to what I just said. Good policy, the right policy starts with the right narrative. And if we continue to run with the wrong narrative, we're not going to be addressing the appropriate concerns. Instead, our policy is going to be going in the wrong direction, and that will inevitably do more harm than good. And more than anything else, as we get through this presentation, I'm going to keep coming back to this idea of the narrative, because the narrative really is the single largest problem in our nation today. So, jumping right in, as noted, in the last 2 years, since we started hearing about those recession calls, what's happened? Well, the economy's continued to grow. 2.8% per quarter for the last 8 quarters. An unbelievable run, very strong growth. Growth in really every part of the economy. Consumer spending is picking up. Business investment is picking up. Exports are looking good. Government spending continues to tick forward. And we're right near the end of October, which means we're going to get our Q3 GDP growth. They always talk about in the papers, what's going to be the October surprise? Is it going to be a big negative number that can throw a wrench into the election? And no October surprise. In fact, the data we get from the Atlanta Fed, GDP now, kind of gives us a running total of what we think is happening. It looks like it's going to be another 3% quarter. So honestly, this is an economy that just continues to move forward. And this is all based on strong consumer spending. And not only are consumers spending at a strong pace, but they're spending things that are fun. I mean, just take a look at some of the numbers. Global travel at an all-time high level. Restaurant spending today is 45% higher than it was 5 years ago. The previous 5 years only grew by 15%. Nevada has never been busier. Gaming revenues at an all-time high level in Las Vegas at this particular point in time. If you want to be jealous of somebody's 10K, take a look at Live Nation. They haven't put a concert on in the last 2 years that hasn't sold out completely, including every single VIP package. This is an American economy having the time of their life right now. And as for financial distress, you've certainly heard a lot about the uptick in delinquencies and credit card debt and auto debt. Absolutely the case. But keep something in mind. Is this the tip of the iceberg, or is it just an anomaly? And actually, I really think it's just an anomaly. Keep in mind that mortgage delinquencies are very, very low. And probably one of the top line numbers for household financial distress, well, that will be foreclosures and foreclosures and bankruptcies, and they are still at record low levels. Oh, they've come up a little bit from those ultra low levels back in 2021, but still half the pace they were prior to the pandemic when they were at a record low level. So this seems like an American public that is doing well and having fun and don't nearly seem to have all these pressures that you hear about in the paper on a day-to-day basis. Well, what about those labor markets? I did mention that you started to see an uptick in the unemployment rate. That's what got everybody all hot and bothered over the summer. But with all that being said, typically we see an increase in the unemployment rate when we're losing jobs in the economy. And we haven't lost any jobs. We still see job growth in the U.S. of about 1.5% on a year-over-year basis. It's also worth noting that there aren't any other signs of worker distress. Yes, the unemployment rate has come up, but there's been no increase in initial claims for unemployment insurance, and there has been no increase in the pace of layoffs and firings in the U.S. economy. In other words, what you're seeing in the unemployment rate seems to be largely driven by new workers coming into the workforce rather than existing workers having trouble keeping their job. That's what's going on there, and again, an increase in labor force is ultimately a good thing for the U.S. economy. Ultimately, the labor market today is still broadly in favor of the worker. You know, a couple of years ago, there were 2 job openings for every single person in the United States looking for economy. We've never seen the labor market quite so overheated as it was then. It has cooled off since then, but there are still 1.2 job openings for every single person looking for a job in the United States. This is still a very, very tight labor market. Employers are still struggling to fill critical positions within their company. And what that means, of course, is that wages are rising, and they're rising in real terms, not just in nominal terms. On the right-hand side, you can see real hourly wages are growing a little less than 4% on a year-over-year basis, and nominal growing about 2.5%, again, in real inflation-adjusted terms. So yes, incomes are growing faster than the prices at this particular point in time. Well, what about inequality? Perhaps that's good for the top 50%. We all know the bottom 50% is struggling and falling behind. Well, even there, believe it or not, the data tells a slightly different picture. Labor markets are not just tight the last couple of years. They've been tightening for the last decade. And a tight labor market is particularly good, particularly for lower skilled, lower pay workers. On the left-hand side here, I'm showing you year-over-year growth in wages for the lowest and highest quartile of earners in the U.S. economy. And your eyes do not deceive you. The lowest quartile of earners has been seeing greater earnings growth than the highest quartile for almost a decade. If you added it all up over the course of the last 10 years, the lowest quartile has seen almost a 60% increase in their earnings, the top quartile only 40%. So income inequality has been falling, and it has been falling for nearly a decade. Now, I'm not saying the fight is over. There is still too much inequality, and there will always be households that need our help, that need a lift. That is what we're supposed to do because we're human beings. But with all that being said, we can take a step back and at least applaud some of the progress we've made. And it isn't just income inequality. On the right-hand side is the U.S. poverty rate. Yet again, the 2023 numbers just came in, and it was roughly 10%, which slightly higher than in 2020, but still the second lowest number recorded in this nation for the last 50 years. This is good news. Americans truly are doing better. Industrial production continues to increase, business investments doing well. Even the housing market looks better when it looks at the GDP statistics. Now, for anybody who's a real estate agent in the audience, you're like, the housing market's not doing well. And yeah, from an existing home sale perspective, this is an awful market. August came in and was one of the weakest months for overall existing home sale this nation has seen since the middle of the Great Recession, right? So that is a very, very cold market. There is not a lot happening. But by the way, that relationship between today and what was going on in 2010, that's the only relationship. Nothing else is related. For example, even though there's almost no existing home sales, home prices in the United States are actually going up. They're not falling right now the way they were 15 years ago, where they were plummeting rapidly. Now, that's probably a big mystery, because how can home prices go up when we know that no one can afford homes? And there's little doubt that affordability has gotten worse over the last couple of years. But how much worse? Really, housing affordability has been a centerpiece of so many of our conversations, really over the last decade, the last 15 years or so. But again, narratives versus reality. Let's take a step back and look at actual affordability. Let me explain what I'm looking at here. I'm looking at the median price of a home and the median income of a household in the United States. And importantly, I'm relating those two through the mortgage rate. So this is more or less what a house would cost you on an annual basis if you just bought it as a percent of your income. And you know, the worst affordability ever in US history was back in the early 80s when interest rates were like 13, 14, 15%. We all remember that. And then it came down, down, down. And right post-Great Recession, take a look at those numbers. In the 10 years prior to the pandemic, we had some of the most affordable housing this nation had ever seen once you account for interest rates. Now, interest rates went up again, and yes, affordability got a little worse, but it really isn't that bad. And by the way, this is still counting a 7.5% mortgage rate. You drop it to 6%, the numbers are clearly getting better. Now, one of the big questions is, well, wait a minute. I thought housing was like super expensive, but it was so cheap just a few years ago. Why wasn't everybody running around buying homes back then when it was so cheap? Well, it's because we were telling everybody how expensive it was. Does anybody else remember in 2019 how we were told, yes, we were going to have a recession, and that recession was going to be driven by the fact that housing was overpriced and those prices were going to be collapsing at any point. And I still remember all sorts of people in late 2018, 2019, coming to my talks and asking me, so when are home prices going to fall? And my answer was, never. What are you talking about? They're incredibly affordable right now. But that's the power of the narrative. It caused people to not buy homes when they should have. Clearly they should have been. And it didn't just have an impact on buyers, it also had an impact on builders. If you really want to know what's happening in our housing market today, it is actually one of the tightest housing markets from the sheer point of view of supply that the nation has ever seen. And I'm talking about existing units. You want to know why there's not a lot of homes being sold right now? Most real estate agents will tell you, it's not that there's a lack of buyers, there's tons of buyers. The problem is there's a lack of sellers. It's a completely different kind of problem. Why isn't anybody willing to sell? Well, because they have a 30-year fixed rate mortgage at 3%. And you will pry that mortgage from my cold, dead hands, right? So there's very little turning over. But it's not just the lack of units coming into the existing home market. It also has to do with the overall housing vacancy rate is very, very low at this particular point in time because builders haven't been building enough either. And all said and done, that explains one of the little mysteries of our housing market, because usually real estate agents and housing development people are either happy or miserable in the same years, right? But here you have a very odd economy where the builders are happy and the real estate agents are unhappy, as the case may be. That odd dichotomy, yet again, is driven by the overall shortage of housing. Our housing problem in the United States is one of supply, not one of affordability. And that's the point I'm going to keep coming back to again and again. As for local housing markets, a very similar sort of picture. Very little home sales and very little for sale. Inventories are way down in California, Sacramento, and Placer. But with that being said, home prices are going up. Placer right now is back to about a median price of about $700,000. That's where you landed in late 2021 after the big post-pandemic boom. And I know that sounds expensive, but take a look at the left-hand side. This is the share of cost-burdened owners across the region. And what's interesting is not only is Placer have a relatively low share of cost-burdened owners, it's actually falling here. In other parts of the state's going up. Here it's falling. So your housing market looks really steady right now. Better news, inflation is cooling off, the stock market is picking up, lots of confidence out there. The Federal Reserve recently announced a half-point reduction in the federal funds rate. I mean, even Bitcoin has come back. Have you seen this? Bitcoin is back to $63,422. Now, we've done a lot of important research on cryptocurrencies and Bitcoin in particular, and we do have a model that kind of helps us determine how it's valued. And our model right now is telling us it's roughly $63,422.80 overvalued, more or less, give or take, right? Give or take, which kind of goes to my point that asset markets look really frothy right now. Now, if you're wondering why my model's saying that, well, a lot of my model came from a wonderful book I read over this last summer. It's a biography of a guy named Charles Ponzi. He lived about 100 years ago. It's a wonderful book of rags to riches, of jail to deportation, of a true American entrepreneur, as the case may be. I suggest you pick it up. It's quite a wonderful read. But with all this wonderful news, how are Americans feeling? And the answer is grim. I mean, consumer sentiment started to come back, but in the beginning of this year, it's going down again. And it's basically where it was back in 2012. It's not just confidence. This is Gallup U.S. satisfaction. And again, the numbers are relatively low at a little over 20%, where they were back in 2013 and 2014. More Americans living paycheck to paycheck. We see these headlines all the time. And even since the start of this year, of course, you've seen an overall diminishment in confidence in the economy. And even a lot of that, of course, has to do with this election. And here's a standard headline. I grabbed this out of the Washington Post. The economy is on the line. Which candidate do we save to trust it? I'm sorry, which candidate? Wow, it's been a long week, pardon me. Which candidate do we trust to save it, right? And I just love that rhetoric. I just showed you a bunch of data. Does this economy look like it needs saving? Does it look like it needs saving? But this is the rhetoric we hear on a day-to-day basis. Even in California. How's California doing right now? Well, it depends on who you ask. If you ask the right, they'll tell you it's a failing economy. Why is it a failing economy? Because of its socialist policies that are driving business and wealthy people right out of the state, just driving them right out of the state. Now you talk to the left, and they will also tell you California is a failing state, right? But it's not a state that's failing because of socialist policies. It's failing because of its capitalist policies that's causing screaming inequality and housing cost burdens that no household can maintain, and people are fleeing the state, fleeing high housing costs and inequality. Now, we do have a third opinion, the governor, and the governor would tell you, no, really, it's fine. It's fine, trust me. It's fine, nothing to see here. Keep moving, and I'm not running for president, I swear to God, right? And with all this being said, look, if I had to choose which opinion is right, it's actually the governor. He nailed it. Actually, it is fine. And I know it doesn't feel that way. I mean, after all, we're not growing as fast as Texas. We're not growing as fast as Arizona. We have this increase in the unemployment rate. But put that to one side. How about the fact that there's been no increase in claims for unemployment? How about the fact that business applications in the state are still much higher than they were prior to the pandemic? Our job openings rate is still what it was back in 2019. None of this looks like our economy's drying up and blowing away in the wind. And as for Placer itself, look, I get it. California's not growing as fast as Texas. Placer County sure is, because this place is not like the rest of California. Great job growth across the board, 1.8%. Almost 8% growth over the course of the last 4 years. This is an economy that's charging forward. Output in California is growing faster than the nation. Again, not quite what you expect. Our GDP is growing faster than the US GDP. Our income is growing faster than the rest of the nation. Per capita income back in 2018 was 14% higher than the nation. Today it's 20%. And as far as wealthy people fleeing the state, keep in mind that in the top 10% of all counties in the United States, 14 of those counties are right here in California. 14 of the wealthiest counties. And go down, 1, 2, 3, 4, 5, 6, 7, 8, right there. In the top 10%, Placer County. Yes, you are one of the highest income counties in this nation. That is an economy that's doing really well. Simple as that. And take a look at the numbers. Real output growth. Again, faster here than most of the state, up 21% over the course of the last 5 years. Of the greater Sacramento area, Placer now has the highest average weekly earnings at nearly $1,400. And on the right-hand side, the share of the population with a subprime credit score, well, still very, very low compared to what was 5 or 6 years ago. Again, what a great economy you live in the middle of. And how about inequality? Again, we're told all the time that inequality is an enormous part of the problem here in California. But when you look at the income data, well, actually, people with lower levels of education have been doing better than people with higher levels of education in the state over the course of the last 5 years or so. Again, income inequality is falling even here. And yes, our poverty rate is near an all-time low level. But what do we hear in the papers? Nearly a third of Californians live at or near poverty. Now, this doesn't match up to the data. I called the PPIC and I asked, well, what do you mean by that? 30%? How can you say that? And they said, well, we raised the number. I'm sorry, what? Well, we raised the poverty line. You just raised it by yourself, unilaterally? Yeah, we did that. What? You can't do that. Well, okay, you did that. All right. Well, what if you did that historically and used that higher rate through history? Oh, well, it's the lowest ever. But you produced a headline that is clearly designed to scare people, not inform them of what's actually happening. And this is the problem. We can't keep doing that. And yes, it's true here as well. If If you look at the pattern of earnings growth, particularly for lower skilled people that are seeing bigger earnings increase here in Placer County, you can see the good side. And yes, Placer County's poverty rate, look at this number. The poverty rate for the state near an all-time low level of 11.5%. Here in Placer, 6% your poverty rate is. So it is one of the strongest, healthiest economies in the nation with a falling level of inequality. Congratulations, this is about as close to paradise as you can get. Simple as that. Now, thank you. Now, all that being said, it's not the story, right? We hear this all the time. The narrative tells us one thing, the reality tells us something different, and they're not lined up what's going on. And you see this all the time, whether it's the positive value of Bitcoin. Again, why shouldn't Bitcoin have value? Very simple. Any kid with a master's degree in computer science can make another cryptocurrency. Ergo, how can any of them be worth anything, right? Now, but nevertheless, you look at the websites, you listen to the logic, there's clouds and clouds and clouds of reasons why you're beating the man and moving around the global, financial system and blah, blah, blah. Whatever it is, we know however thin you slice it, it's still baloney. But the middle of that fog of baloney, real value emerges. And I'm not upset about it. I'm jealous. Really, I am, right? I wish I had figured out how to create value out of thin air. But obviously, it can't last. Narratives without reality can't last. And by the way, ignoring reality also can't last. I already mentioned the federal deficit. 6.2% of GDP, 120% debt to GDP. Huge increases in spending on Medicare and Social Security in just the next decade. Yet for all that being said, how many minutes of the last presidential debate were devoted to solutions to the deficit? 0. Thank you very much. And you go, what's going on here? Well, before you point a finger at Harris and Trump, keep one thing in the back of your mind. They don't decide what they're going to say in those debate stages. There's a group of people who go to focus groups and spend all sorts of time questioning people to ask them what they care about. And if they didn't talk about it on the debate stage, it's because those focus groups said, these people don't care about it. So if you ask why the politicians don't care about the the deficit, it's because we don't care about the deficit. It always has to come back to us. We are the source of that situation. Now, when you start thinking of the world in this way, you see narratives everywhere. You see them driving interpretations of economic news at the root of economic bubbles. You see them driving these bad policy choices. Robert Shiller, Nobel Prize winner in economics a few years ago, wrote a book called Narrative Economics, where he laid out that why we need to pay attention to the narrative, because if you don't, you remain blind to a very real mechanism for economic change. Hear, hear. But Shiller's smart, but he's not that smart. It's all been said before. We know that. One of my favorite California philosophers is Will Rogers, who famously said over 100 years ago, it ain't what we don't know that's going to hurt us. It's what we know that ain't so. In other words, he's talking about false narratives. Even back then, they knew that people believe things that weren't true, and that is inevitably what gets them in trouble. And the new American narrative over the last 15 years has been nothing but how bad it's been. And all these headlines were coming out where always someone have another reason why that great data release was something that just wasn't important, and really honestly things are terrible. And for a while I just had kind of a punchline. I called it the age of miserabilism, right? So it rolls off the tongue. That's cute, but whatever, we can ignore it. Can we? You can't. Because the whole idea that the wrong policy starts with the wrong narrative really came to the forefront when the pandemic hit. Now, the pandemic was tragic. There's no doubt about it. Millions of people passed. We were stuck inside for a year. It was scary. It was lonely. It was uncertain. I appreciate all that. What it wasn't was an economic game changer. This idea that the pandemic was going to cause a depression, as we saw in those headlines, that doesn't make any sense. I study business cycles. I have never seen a depression caused by a pandemic. The Spanish flu was way worse than the COVID pandemic. There was no depression back then. It's not how it works. But it fed the narrative, and man, was that acted upon. Now, we were saying back then, look, don't count out the V, and the V is exactly what happened. It was the deepest but shortest recession in U.S. economic history. You look at the data, we were fully recovered by the beginning of 2021. But reality meant nothing in that narrative bubble called Washington, D.C. They were going to save us no matter what. The pandemic cost the U.S. economy about $1.2 trillion in income. In return for our troubles, we got $6 trillion in stimulus lobbed at the economy. $5 of stimulus for every dollar of lost income. By the way, that adds up to $50,000 of stimulus per American household. I mean, wow. No wonder the economy went absolutely crazy. And it wasn't just the 50,000, it was the enormous asset bubble they set off in the back end of that. For the 50,000 in initial cash, Americans inevitably got $300,000 in brand new net worth because of that enormous asset bubble. And it wasn't just the top 10%. Every level of income saw an increase in their net worth. All that money, of course, set off an enormous spending binge. And it was a spending binge. It was not people desperately trying to cover the necessities. I mean, 113% increase in air transportation, 70% in foreign travel, 62% in sporting equipment, 50% in restaurants. Go down to the bottom for education, supermarkets, and pharmaceuticals, and look how much lower those numbers are. People were partying. And when you talk about people spending money in an economy full of dollars, well, that's inflation. And of course it generated inflation. One of the oldest cliches in economics is that inflation is caused by too much money chasing too few goods. It is a demand-driven phenomenon. Always have been, always will be. Now, the Federal Reserve, of course, had to jump on it, and they did. They cranked up the interest rates. They started quantitative tightening. By the way, dirty little secret on the rate cut we saw earlier this year. They did indeed cut the federal funds rate by half a point, but they did not stop, of course, quantitative tightening. They continue to shrink the money supply, which is ultimately keeping those 10-year bond rates up. If you're wondering why 10-year bond rates come up since the meeting, it's because, again, they're cutting the federal funds rate, but continuing quantitative tightening. This is about unwinding the yield curve, which has been inverted for 2 years. It's not about stimulating the economy. And by the way, that's the right move to make at this particular point in time. If you think about the consumer where they are, well, we all know about that initial pandemic implosion where people just stopped spending because they were stuck inside. But then we had that enormous bounce afterwards because of all the money thrown at the economy. And the Fed got involved and cranked up interest rates and cooled things off. And now we're getting back to normal, right? Getting back to normal. And that's what's really happening. We're getting back to normal, not just in terms of our pace of spending, but also what we're spending on. We're buying a few less goods and spending a little bit more on services. And we take, for example, a look at taxable sales here in the region. It has been flat over the last couple of years, but only after that initial surge. People are not spending less. They're simply spending less on goods, which are taxed, and more on services, which are not taxed so much. And that's why you see that flattening right there. The key point here is Americans are still in a really good position to continue driving the economy forward. Real disposable incomes continue to grow. U.S. household net worth, even though inflation's cooled off, asset price inflation is not. Again, the stock market continues to climb. The Bitcoin is back. Home prices continue to go up. And Americans are now sitting on $47 trillion more in net worth than they did a few years ago. This is what's driving the U.S. economy forward. So things looks great until you pick up the paper. And in the paper, you're going to hear about how people are suffering because of inflation. Even recently, 70% of consumers feel inflation outpacing income. Or you hear from The Economist magazine, could the inflation nightmare soon be over? It's amazing how we paint inflation as this incredibly negative shock to the system, when in reality, inflation has been driven by the enormous surge in consumer demand that came from all that stimulus thrown at the economy. Now, how do we get in such a weird place? How do we end up in this odd space where we see the world in a different way? Well, look, I could spend 3 hours talking about the psychology and the sociology of this, but a good start for anybody interested in this stuff is Daniel Kahneman. He wrote a book called Thinking Fast and Slow. Daniel Kahneman was a researcher in psychology who won the Nobel Prize in economics, to give you a sense of just how powerful his vision of human decision-making, human recall is, and how he changed the view of how people interpret the world. Basically, it boils down to this. You have two ways of thinking. You got your type 2 brain, that's the smart brain, that's your digital, modern, fancy brain. That's the one that allows you to solve all sorts of complex problems. But he points out, and a lot of folks have talked about this, your type 2 system really is not as sophisticated or as powerful as you think it is. It's a 286 chimp in a Pentium world, for those of you a little bit more on my age range, as the case may be. As a result of that, of course, your type 2 system is often busy. You can only think about one thing at a time. We truly are one thing at a time kind of people, simple as that. And it's often lazy. You know, sometimes after a day of hard work, you can't think at all. You want to go home and watch reruns of Friends until midnight just to let your brain unwind, right? So it's a powerful system, but it's a limited system. Well, if type 2 isn't operating, who's running the show when type 2 is turned off? And that's type 1. And that's the old-fashioned system. That's the analog system. It's fast, it's instinctive, it's emotional, it's incredibly efficient, but that efficiency comes at a cost. That cost has to do with what we call cognitive biases. And a cognitive bias is nothing more than a kind of an engineering quirk. Talk to an engineer about how you make motors work, and there's always trade-offs. There's always trade-offs. You want more power, you got to have less speed. There's always trade-offs. And that's what a cognitive bias is. It's a trade-off. Classic cases of a cognitive bias, of course, is an optical illusion. This is the old ditty about, are those horizontal lines parallel? And your type 2 brain will say, of course they're parallel. You wouldn't ask that question unless they were parallel, right? That's type 2 thinking. But your type 1 brain looks at that and goes, those are not parallel. Why? Well, your eye doesn't want to just determine what that is, but it also wants to determine how far away it is. And it uses shading to give it some clues on depth. And what's happening here is those black and white boxes are messing with that mechanism to make those lines not look horizontal, not look parallel, when in fact they are indeed parallel. Again, it is an optical illusion driven by this cognitive bias as part of your brain. It's how your eye works. Well, imagine that every bit of information that comes into your head goes through a similar mechanism that could have similar biases attached to it. And now you start to see how we really interpret the world in ways that may not be quite true. And, look, if your type 2 system is there, if it's actively monitoring, it can take care of this. It can control it. But again, your type 2 system cannot be there all the time. It's not what it does. It can only think about one thing at a time, and it's easily tired. So more often than not, you are using your type 1 system to interpret the world through that particular world. It really boils down to this. We don't think as much as we think, right? But where it gets even a little creepier is when you realize the relationship between your type 2 and type 1 thinking. Look, we call it the elephant and the rider. Type 2 is the rider, type 1 is the elephant. And the argument here is the rider has the illusion of control. I'm sitting on the elephant, I'm telling it where to go. And for the most part, the elephant will be docile and simply go where you point it. But let's be honest, if the elephant says, I want to go left, even though you tell it to go right, you know what? It's going left. Simple as that. You have no control over it. You are at the mercy of the elephant. And what's even interesting about this is when you look a little closer, people even have the ability to what we do call post hoc rationalization. Type 2 says, the rider says, go right. The elephant says, I'm going left. So what does the rider do? They go, you're right, I always wanted to go left. That's post hoc reasoning. And we see it in people all the time where they struggle to justify their beliefs. They struggle and struggle. No matter how silly it gets, they will continue to go down that to justify those particular beliefs. And when you think about the world today, understand that every time you pick up the paper, someone's telling you how terrible and tragic and awful it is. And you know what? It gets into your head. I was in a room of people just a few minutes ago, and someone asked, how is Placer doing? Is it doing well? Raise your hand. And almost no one raised your hand. I'm going to go back to what I just said. This is one of the most successful economies in the nation. And yet people even here are like, well, I'm not quite sure. This is the real issue. We're not paying attention to the world as it should be. And it's not just you. A survey came from the Federal Reserve. It's wonderful. They asked people on a scale of 1, how are you doing? And people in 2017, the average person said 74. Today it says 72. The average person feels they're just as well off today as they were in 2017. But then they asked them how everybody else is doing, and everybody's quite positive everybody else is doing badly. This is an odd thing. So the average person thinks they're doing just fine, but the average person thinks the average person is doing terrible. It doesn't work like that. It's like, 90% of drivers think they're above average. It doesn't work like that, okay? But this is the world we live in over and over and over again. And, look, the real issue in our world is labor supply. We talked about that, right? We're not having enough babies. Birth rates are down. We know our population pyramid is now a population column. By the way, how do you fix this? Well, the answer is more immigration. We talked about this I got this a decade ago. Now, a decade ago, a bunch of economists also talked about reforming the income tax code, increasing the social retirement age, and reducing federal deficits. None of these occurred. Apparently, people in D.C. listen to narratives more than they listen to economists, but that shouldn't be a surprise to anybody by this particular point in time. There is a backstop to this, and that is migration. And we are getting people into this nation. The official numbers for people coming in here are 1 million a year. The unofficial numbers are over 3 million people per year. And that's, again, why the unemployment rate's going up. A lot of new entrants. And if you look at the data, one of the reasons the economy is so strong today is because of all these workers. They're filling jobs. They're making our firms operate. They're taking care of business, and they're spending money, and they're helping the economy grow. But Americans are quite positive this is the worst thing that's ever happened to our economy. What a strange difference between narratives and reality. Now, don't get me wrong. Unimpeded immigration in this nation isn't necessarily a good thing. But with that being said, we're not trying to fix our regular, normal immigration system either, our legal system either. So where do you go here, right? Where do you go? But again, narratives versus reality. As for our economy, well, it's the same sort of picture. We have a problem. We don't have enough labor force growth. Here's a real story of California. In the last few years, we've added 640,000 payroll jobs, but only 13,000 people into our labor force. Not a sustainable situation, as simple as this. And it's all about housing or the lack thereof. Now, if you think about then the fact that we don't have enough housing, one of the questions is, why are people leaving? Well, here's an interesting concept, and let me just kind of give you something to think about here. You hear people are fleeing all the time. What people don't bother to tell you is that actually housing vacancy rates are at a record low level. If people are fleeing California, why is there no vacant housing? How do you put those two things together? They don't fit together. And the reason for this, of course, is, well, it is true we have fewer people in California, but we have more households. The real issue in California is that people are spreading out. There's been a big decline in people per household, and that is a problem when you don't have enough housing. Now, why do people spread out? Well, they do so because they're doing well. And if you want to see it in action, just take a look at, for example, Alameda County. Alameda County has expanded its number of households by 10%, but people per household has dropped by 7%. There's the rub. The vast majority of new housing in Alameda is not being lived in by new people. It's being lived in by the existing population base that's spreading out. That is a different kind of issue, and we have to recognize this. It's not a question of affordability, because if housing was that unaffordable, people would be clustering together. They wouldn't be spreading out. It'd be moving in the other direction. The problem is housing supply over and over and over again. And I'm not going to worry about this because I'm running a little late here, but you can play with this on your own time. As for the local labor force, what has been the success of Placer County? It basically boils down, well, to housing supply, which in turn has driven labor force growth. And it's good labor with good jobs in a well-growing economy. You can see the numbers here and how it continues to grow. And then it boils down to the big increases in housing stock. In the last 10 years, Placer County has increased its 10-year it's single-family housing by 20%, and it's multifamily housing by 10%. Now, I will tell you, it's a little off balance. You need more multifamily, right? But nevertheless, it's good to see you adding more housing, and that is one of the primary drivers of growth in this region. Keep doing it, because you are proving what the rest of California needs to see happening, which is if we got out of the way and got more housing built, it would make this entire state that much more powerful, as the case may be. And if you look across the area here, we do use the confidential employment data for the county. We work with the county development folks. They asked us to show some stuff. And, you know, you could talk about the different kind of jobs in these different areas. I mean, Roseville, 4 years, 11% new jobs in this city all by itself. Again, driven by housing, driven by population growth. You're showing it can be done and be done in all the right ways. You can see those strong numbers there. Now, there has been a little bit of a slowing down in the population. You know, one of the things here Placer is dealing with, even here, people are spreading out, and you see the decline in people per household. The way to deal with that is to continue to lean in, and get more permits going up. But the one thing I'm not seeing here is an increase in permits. They continue to move along at roughly 200 to 250 units per month. You need more than that. You need to lean in on it. And you particularly need it down here, but you need it in other parts of the county as well. So even here where you've built enough housing, I can only say you still need more. You still need to lean into that change. You want to vote for Measure B because you want to have the roads for all this as well. Keep this in mind as you're going ahead and moving forward on things. It is supply, not affordability. And you know, anybody who's thinking about this Prop 30 thing, if anybody thinks that rent control helps housing supply, come talk to me. We got a lot to talk about, okay? It does not help by any stretch of the imagination. So what about the election? Let's wrap up here before we go out, call this session to an end. What about the election? What are we to make of it? Well, I get it. These are two incredibly different people in every way possible, right? Where they came from, what their stances on all sorts of social issues are. They do not see eye to eye on things. But go back to what I said. Ultimately, their economic message is a message driven by these focus groups. And when you look at their economic messages, they look really similar, right? Take, for example, they both agree the economy's doing terrible and it's the other person's fault. They agree on that, right? But I showed you the economy's doing fine. It's not doing terrible. It doesn't need to be saved by either one of these candidates. Their fiscal policy, we need more taxes and less spending. Sorry, that's how you deal with government deficits. Both of these folks are talking about tax cuts and spending increases. A different balance, but both moving in the other direction. And they're both worried about manufacturing and industry in the nation. But remember, the problem with manufacturing and industry is not enough workers. Simple as that. So more workers will help industry. Neither one of them are talking about that. Rather, Harris wants to talk about subsidizing startups in an economy that doesn't have enough workers. And of course, Trump wants to use tariffs, which don't get me started on that chaos, as the case may be. Obviously, what we need to do is fix our legal immigration system to promote more immigration into this nation to continue to feed our industry and help our economy grow that much faster. Also, we can afford my Social Security and Medicare when I finally get to that part of my life. Thank you very much. Not just all about me, but it's all about me. Anyway, so are we out of the woods? And we were never in the woods. We were never in the woods. There was never going to be a recession. Simple as that. Consumer demand remains strong, and this expansion is going to continue. It isn't over. I'm not saying everything's great. Obviously, federal deficits, a fraud of the asset market, growing external imbalances. It can't last. Canary in the coal mine for the next business cycle, the U.S. dollar. The dollar starts to subside. That means the rest of the world is not quite in trance with us as they used to be, and that's when the wheels start falling on the train. Is that 2 years? Is that 4 years? Is that 6 years? I have no idea. I have to keep inviting me back, and you'll find out when it happens. Last but not least, California, proving the road to hell is paved with good intentions. The only way to put it, right? I mean, yes, I appreciate the people in Sacramento are well-meaning. I understand they want to help Californians. But if you start with the wrong narrative, you're going to come up with the wrong policy. And the wrong policy time after time after time. Look, we have a Dutch disease problem. We don't have enough workers. We need to increase the number of workers to help our economy going. And that's not an affordability question. It's a supply question. And as for minimum wages, look, you're not going to upskill people. Not uppay people, not just keep increasing wages. I mean, it's amazing. We know California is expensive. California is a very high cost of living. And the story always is, well, when we have to increase incomes for low-skilled workers. Well, I have a different idea. How about we just lower the cost of living for everybody? And you do that by promoting efficiency, particularly efficiency in government. That's a whole other way of thinking about it. Don't just keep layering on rule after rule, regulation after regulation. Focus on making things more efficient, which reduce the cost of living for everybody, and everybody should be able to get behind that. So why aren't they doing it? Thank you, but they're not doing it. Why? Because of the narrative. In the end, it's about the narrative, right? Our narrative is wrong, and it's guiding ugly politics and misplaced policies. We need to get the narrative back online, and you know, that's the hardest thing to do of all. How do you get the narrative back on track? Well, listen, you start with this right off the bat. We first all have to understand that yes, we are all human beings, and we all have these narrative issues. We all see the world in a different perspective than what the world actually is. I think if we can all take a step back off these predilections, when we take a step back off these strong opinions we have, and all recognize that we don't see the world quite white, I think that opens up a possibility to have better conversations and to find places in the middle and to find solutions to make everything a little better. But we can't do it until we all recognize that we are all part of the problem. We're all part of the problem. And as Mark Twain famously said, it is easier to fool people than it is to convince them that they have been fooled. Well, it's time for us to acknowledge that. Thank you very much, everybody. I appreciate your time today, and keep classrooms wonderful.